Okay, let's look at the big picture of what Chapter 14 is all about. It's actually pretty simple. Let's start with something you already know well from our earlier chapters. Question: how do firms make new investment decisions? The answer is, in Chapter 9, we looked at 4 very different ways to evaluate an investment opportunity, and sort of the winner was the net present value criteria. A project or an investment should be accepted if its net present value, NPV, is greater than 0. Otherwise, the project should be rejected. How do we find the net present value? The net present value formula says we take spending in year 0, which is a negative cash flow, and add the present value of all future cash flows coming from this investment. Let's kind of expand it a little bit. Spending in year 0 with a negative sign because it's a cash outflow, plus what's the present value of all future cash flows? It's cash flow in year 1 discounted, or mathematically divided by 1 plus the discount rate. Then we add cash flow in year 2 divided by 1 plus the discount rate squared. And so on, we keep adding additional discounted future cash flows estimated for this project. The focus of this chapter is the discount rate. Up until now, it has been given to us. So the required return on similar investments is 10%, for example. We will no longer use some given number in our net present value problems. So what should the firm use for the discount rate when it's trying to find out whether a new investment is worth it or not worth it? This is what these chapters focus in, the discount rate. So how do firms figure out what discount rate to use? Once again, a common sort of problem in finance, or at least that's what a lot of students always complain about, is the same thing can have so many different names. Well, it's coming up again. Discount rate can also be called a typical return for investments similar to this one, or a required return on an investment. We saw a whole bunch of other terms like when we talk about bonds, we say yield to maturity. Then we can also say interest rate, rate of return, growth rate, right? APR, which stands for annual percentage rate, and so on. In this chapter, we will also use a couple of additional terms: cost of capital and weighted average cost of capital. So these 2 terms will be new in this chapter. Okay, so let's say a firm wants to invest into a new investment project. There's a lot of money required for that, which we typically call net capital spending, right? It could also be some increase in net working capital, like we saw in Chapter 10 in this class. So we might be talking about hundreds of millions of dollars that need to be spent. Do firms in real life have this kind of cash lying around? Usually they don't. So they need to raise money for new investments. And firms often do so from 2 very different sources. Maybe just one of them, or maybe both. One, they sell new shares of stock. So that's the equity source. 2, they can borrow more money. And large corporations that need to borrow a lot of money, the easiest way to do so is issue a whole bunch of new corporate bonds. So each bond is like a mini loan that brings money to the firm. Okay, so there are investors that buy our firm's bonds, so they provide money to the firm in exchange for corporate bonds. Then there are other investors, stockholders, who buy firm's stock shares. So that's another source of money for the firm. The firm issues shares of stock, investors buy them. In return, the investors pay money to the firm. Okay, so is getting money from bondholders and stockholders free to the firm? Of course not. Nothing is free in this world. There's no free lunch, like we say in finance. It costs the firm money. We say there is a cost of raising debt and there is a cost of raising stock. So it's like a dollar amount that goes back from the firm to each of these two groups of investors. And now when we know what the cost to the firm is of using this money that bondholders and stockholders provided when they bought the firm's bonds and stock shares, we can then say that, okay, since the firm is now responsible for making these payments back to bondholders and stockholders, by the way, what are those payments? It's basically coupon payments on bonds, face value in bonds, dividends on stocks, those kind of things. Because the firm is now required to make all these payments every year back to bondholders and stockholders, it needs to be able to raise enough money every year from all of its investment projects that would be high enough for these required payments, high enough to cover the cost of raising debt and the cost of raising stock. So the required return on any new investment is some sort of average, or we say weighted average, cost of capital. So it's like some sort of average of the cost of debt and the cost of stock. Let me give you an example. Let's say bondholders pay $100 to the firm to buy the firm's bonds. In return, every year, the firm needs to pay back 4% of that, the money that came in, right? So it needs to pay coupon payments, those kind of things. Similarly, for stocks, when investors pay money to buy the firm's shares of stock, the firm is now required to pay back, let's say, 6% of that amount every single year. So every year, the firm needs to pay 4% back to the bondholders who bought the firm's bonds, or like 4% of the amount that the bondholders provided to the firm, that the firm raised from bondholders. And every single year, the firm needs to pay, let's say, 6% of the money that it raised from stockholders by selling new shares of stock to the stockholders. The average of 4% and 6% is 5% if we assume that equal amounts of money came to the firm from these two groups of investors. So 5% is the simple average of 4% and 6%. And what we can now say is that 5% is the bare minimum that this firm needs to earn every year from new investment projects on the money that it invests at the beginning of the project. So this is the required annual return on the money invested into any new investment project. I have pretty much explained, everything in chapter 14. And now we'll just look at some, technical details. So we're going to review what we mean by cost of debt. And by the way, it will be literally a review of something we saw in chapter 7 on bonds. Then we're going to review formulas that are relevant to calculating the cost of raising stock. That will be chapters 8 and 13. And then we're going to put the formulas together. Okay, so that's the plan. So to summarize, a firm needs to earn at least the required return to compensate its investors, stockholders and bondholders, for the financing that they have provided to the firm. And so the required return on any investment project is the weighted average cost of capital. So it's like the average of the cost of debt and the cost of stocks. It's also the same thing as the proper discount rate needed to calculate the net present value of a new investment project. Okay, in other words, the weighted average cost of capital, so we are now kind of starting to derive this sort of average of the cost of stock and the cost of debt. And we're going to be calling it weighted average cost of capital. So the weighted average cost of capital is some sort of combination of cost of stock and cost of debt, some sort of average of the two. So I'm not putting any mathematical signs like plus or minus here. I'm putting the and sign. We're gonna get to the exact formula over the next slides. First, let's expand it a little bit. Cost of stock. Is there just one type of stock that a firm can sell? No. From one of our earlier chapters, which was chapter 8, in which we looked at stocks, you may remember that there are two types of stock. One called common stock or equity, and the other one is called preferred stock, which has preference over common stock shares in paying dividends to the investors. So the weighted average cost of capital is a combination, or more like the average, of these three things: cost of equity or common stock, cost of preferred stock, and cost of debt. These are the notations that this chapter will be using. It's all R's because everything is returns, percentages. Weighted average cost of capital will be denoted by WACC or R subscript WACC. The cost of equity will be denoted by capital R subscript capital E, or E and then in the brackets R subscript E, cost of preferred stock R subscript P, and cost of debt R subscript D. Let me rephrase the idea behind the weighted average cost of capital. Essentially, for the first time in this class, we are looking at things like dividends that the investors receive who are buying shares of stock, or coupon payments that the investors who are buying bonds receive. We are looking at those from the point of view of the firm, rather than from the point of view of the investors. So, from the firm's point of view, the cost of capital is the price that the firm has to pay to stockholders and bondholders for raising money from them for its investment projects. So the firm needs to pay dividends, the firm needs to pay coupon payments on bonds, right? If the firm raises money by issuing stocks and bonds, then its cost of raised capital is the expected rate of return that needs to be offered, that the firm needs to offer to its stockholders, as well as the rate of interest that it needs to pay to its bondholders. So everything is from the firm's point of view in this chapter, how much the firm pays, which is the same exact, amount of money as what the investors receive, or the return to the investors. So from investors' perspective, the weighted average cost of capital is the return that these investors, stockholders and bondholders, require that the firm makes on its investment projects, that would be just high enough to cover the necessary payments to them, to stockholders and bondholders.